Our next panel is all about credit. It's time to give credit where credit is due. And it is a conversation that with a bunch of experts that we have, but I want to first bring up our moderator, Cynthia Campbell, who is the Chief Experience Officer at Balance, and she's helping members every single day rebuild. Next, we have Harold Roundtree, who is the CEO at Uncle Credit Union, and he's had exceptional loan growth, both in real estate and in auto, and we'll maybe kind of have the perspective of some risk-based pricing and how to reach people. Next, we have Selfa Saucedo, and she is the board of director at Ventura County Credit Union, and she has an interesting perspective on demographics and societal trends. And finally, we have Scott LaSalle, Saretech, GDS Link, and he in fintech is a founder, a board member, and really will talk to us about the power of analytics. Should I just stand right in front of her? Does that make it better? Next time I can go right around. Please turn it over to Cynthia. Take us away.
Hello, everybody. Thank you so much for this opportunity, Brandy, Sue, and Zach. Credit's got to be one of my favorite topics. I work for Balance. It's a national nonprofit, 53 years old, and we work with about 300 credit unions to be their outsourced financial counselors. So we're working on budgets and credit scores, a big topic these days, student loans, first-time home buyers, getting out of debt, all of those things. So when I saw the credit conversation and my wonderful panelists, I thought this is going to be fun. What's great about being on the second day is you have so many people that have gone before you have said these really cool snippets of information about the topic. And so, there's some things that we can dive into a little bit. And one of them, yesterday, there was 2 or 3 panelists who talked about the FICO score not being unbiased, right? Being biased against minorities and why it shouldn't be the only thing we hang our hat on, but it is a big thing we hang our hat on, right? So let's talk a little bit about that. After I heard that comment, I did a little research. The Center for Responsible Lending has been quoted as saying, credit scores are reflective of the history of discrimination in this country. There's a whole book out that says it's called The Algorithms of Oppression, and it's all about the FICO score and that other algorithms that are part of the oppressive situation. So I think there's a couple things. First, I was wondering, how many of you are on FICO 8? Anybody know? Raise your hand if you know. It's the most popular model out there. It's the one that most FIs are on, but there's a FICO 9. There's a FICO 10, and those FICO 9s and 10s add things like rental history. They make medical debts less, counted in the score. So there are ways to be more inclusive if you're using that score by just getting on the most current model so that it's the most fair model for your members. But certainly there's a lot of other things we can do, right? And we heard about QCash that can give a member a loan in 60 seconds or less, and it doesn't use a credit score at all. It uses like a member score and how they behave with your institution. So my illustrious panel here, thank you all for joining me. The question posed on the brochure was really, how can credit unions be more inclusive? We're still using the FICO score, right? And how can we use it? What other things can we be using in addition to the score to make sure we're being as inclusive as possible? Just like to open it up for first rounds of comments. Would like to start?
I'll start on the first piece there. What happens in Vegas stays in Vegas. Everyone, are we in agreement on that? Okay. So for Uncle Credit Union, what is Uncle, man from Uncle, what does it stand for? Let's get that out of the way. University of California, Livermore employees, the folks that work with the nuclear arsenal to make sure it works on old weaponry, if you have to use it. No, not a popular topic here, but about 8,000 people doing that kind of thing. So one of the things when I said what stays in Vegas, for us that we discovered, we were on FICO 3. And we had been on that model for about, double digits, we'll say. That's what we want to say. So I would encourage people to go back. We were always out of alignment as we work with some of the dealers. We worked through CU Direct, and we were having these battles about buying paper and the like. And so I think that that's going to be very, very important to make sure that you're on the right model. And then the other things that I think that is important for credit unions when it comes to, a lot of people in different communities don't trust financial institutions as a whole. I can always remember my mom and dad, they were from the great generation, and they actually had a deed burning party when they paid off their mortgage. They just didn't like credit as a whole, coming from the community that lived at different times and just didn't trust it. So I think it's going to be a lot of education about the value of credit for different communities, other than just a FICO score, and making sure you have the most recent model. My career, I worked at World Savings many, many years ago. That was a $125 billion bank. SNL, they stopped calling themselves a bank, and then they became an SNL. They were sold to Wachovia, I think, in 2006. They did exclusive B-grade paper for loans. I think someone talked about Maslow's hierarchy of needs, having a home and the like. Within different communities, in the African American community, home ownership is down in the low 40s. So you have to have those kinds of programs that sort of make sense. I think I saw Joan here. She's a member of FHLB San Francisco. If you work with that organization, they're doing things for first-time home buyers where you can partner with that organization or some of the organizations you work with that might promote the basics of home ownership and the like. So those are some of the things, a little bit of this, a little bit of that people that have been out there doing it a long, long time ago, long before fintechs, way back in the 90s. Imagine doing B-grade home loans, portfolio lender, and they did it pretty well. So it's funny, there was even a movie star that had, sort of marginal credit, but they always paid their bills. When they were on television doing their jokes, I always remembered that movie star. But so it happens across different phases of life.
What caused you to change your credit score model after double-digit years? What was the final thing that made you go ahead and do that?
We have boots on the ground. We have a gentleman that calls on our car dealers, and he would be coming back and saying, you know what, you've got this score, and they have this score, and we just sort of got tired of it. And so I think that was a time to make a change. You still have those arguments. We partner with the fintech here, Alchemy. We made a very challenging decision to go to a new digital platform. And with that, we got Savvy Money out of that piece where you're a much more robust experience when it comes to credit. Before, we used to use a little dot map. We'd take our little quarterly FICO scores, and that's all we shared with the membership. But now that becomes a much more robust conversation. But the issue was we just got tired of all the bantering back and forth.
I love the mention of the fintech Savvy Money. If you don't have something like Savvy Money, they're probably using Credit Karma, who have been pushing your members to Discover cards for 20 years, right? So Credit Karma is out there, and they're offering things to your members that are not you. So Savvy Money allows you to offer them your items. So let's talk to you, Selfa, about the FICO score and how your credit union, you're on the board of a credit union. What are you doing to make lending more inclusive?
Well, I'm going to approach this from a slightly different perspective. Yes, I am a board member, and yes, I am still learning about fintechs and everything that's been talked about today. And frankly, to be up here after all of this previous speakers is a little bit intimidating. So forgive me if I stutter a little bit. I am actually first and foremost a public health professional, and so the pandemic really exposed the inequities that exist in our communities. We've always known that communities of color have been disproportionately burdened historically, and the pandemic just really exposed those inequities. And in the public health setting, we rushed to try to accommodate and reach those populations that were being most impacted. And we realized that there was a need to really meet people where they were, and to really understand their situation, and to really understand where they were coming from, because it's not easy. You cannot treat people the same way every individual. We all know that our prime borrowers, they get better credit, housing, even career opportunities. Our subprime borrowers are subjected and in certain cases, I would say, punished for with higher credit cards, mortgages, higher interest mortgages, and our ability as a credit union to try to serve both is going to be stretched, and never has it been more visible as now with the pandemic. We understand that Maslow's hierarchy of need in public health, we look at the social determinants of health. Social determinants of health show us that individuals are a product of their lived experiences, right? So individuals who, social determinants of health, for those of you who aren't familiar with the term, when I first heard it, I was a little bit intimidated, mean all of the conditions in which people live, learn, work, play, pray, and age. And all of those conditions impact an individual's ability to access services, to improve their condition in life. And that goes for economic stability. Economic stability is one of the key pillars of an individual's ability to be healthy, a community's ability to be healthy. And if we're trying to improve our membership's financial health, we have to approach it from the perspective of, what am I offering my field of membership, my members? Do I know my field of membership? Do I have people within my institution who can speak to the condition of the field of membership? Am I really making an effort? In Ventura County, the Board of Supervisors adopted a racism as a public health crisis. And with that came learning. Our Board of Supervisors had to really consider what we were doing as an institution, as a county. We employ over 10,000 county members and county employees, and we had to consider what we were going to do differently if we really were committed to addressing racism in our county. And one of the things that as a result of that, we created a council of all the departments in our county to address the issue of racism in our county. And one of the things that we identified was that if we were really committed to addressing this, we were going to throw resources at it. So the question about what do we need to do to be more inclusive in this arena, to truly reach our communities, and especially those communities who need our help the most. And it boils down to having resources to support those efforts. Without exception, all of the departments that were part of this council, DEI council, we concluded that we can't do this work if we don't have a resource within our own department to help us know our community, to understand our community, and to understand their lived experience. So if we're wanting to reach our community, we need to have a resource within our own institution that tells us, this is the community, this is what your community needs, this is how they need it. They are their immigrant population, indigenous population, they're young workers, hard workers, good savers, but the FICO scores don't reflect that, and don't support their efforts to get ahead in life, because they don't have enough credit history, because they don't have any savings history. Perhaps the immigrant population, the indigenous, they don't have a bank history because they don't bank. They don't bank in their country, and they don't bank here. One of the reasons why they don't bank is because they distrust the system. They don't trust banks. Somebody said that earlier. It's very true. They don't trust banks. And for the most part, if we as board members don't know the difference between a credit union and a bank, you can bet your bottom dollar that immigrant populations don't know those differences either. So how we treat them, how we make them feel when they walk through our doors, or how we reach out to them is how we do it needs to be reflective of their the way they need to be treated. So one last thing before I forget, I wanted to just leave you with the thought that if we want to treat people equally, we need to treat them differently. And that means that you need to understand the community that you're working with and their needs.
Wow, thank so much there to unpack. I think, Sue, if you're in the room, we could put this down for another panel, the connection between health and wealth and the social determinants of health, because there are so many things credit unions can do to affect those social determinants of health. The biggest one is housing. Think about it. If you have an unhealthy home, mold or pests, all of that affects your health. Health means you can't go to school, which means you can't learn, which means you can't get a great job. It's just like this cycle that continues. So I love the health wealth connection, and having you come from public health to a credit union board is brilliant because health and wealth go together. Scott, tell us a little bit about what you're doing. I know that you work with credit scores and you help credit unions use the score and models to uncover lending opportunities. Can you tell us how you're inclusive?
Sure. So first, let me give you a little bit of my background. I won't bore you. I've got a master's in statistics. I started as a modeler. I'm on the board of a fintech. I'm chairman of the credit committee. So I think I know a little bit about the topic. So first, let's do math in public, which is always a scary thing and embarrasses people. All right. So I'm talking FICO 09 here, which is used with Experian data, not FICO 08. It's close. A 580 to a 620 FICO. What are the loss rates there? The odds are 4 to 1. That means you got 4 goods and 1 bad. So everyone in here at a credit union would say, oh my gosh, I'm not touching a 580 to a 620. That's so bad. But you're saying no to 4 good members. Does that make sense to you? You can drive a truck through that. Now, let's talk about laziness. A 720 FICO and above. You got odds of 33 to 300 to 1. So on average, 60 to 1. That's why everybody does the boring. FICO is not credit policy. FICO is not a credit model. So I look at it this way. It is a tool that you can use. It is something that was built, and it fits 80% of the population. Sort of like our educational system, right? It doesn't, let's be honest, it doesn't fit the tails of the population. And who's in the tails? Immigrants, lower educated people, minorities, whatever it is, that don't have credit. FICO is built on thickness of your credit file. Well, if you only have 40% home ownership in the African American community, they won't have a thick file. That doesn't mean they can't pay bills and they shouldn't get credit, right? So stop using FICO in those segments. So we have built tons of models. People are talking about open banking. Open banking has many definitions, just like fintechs, 10,000 fintechs, don't get me started. Open banking is using bank transaction data, the deposit data you have. So we've built tons of models on populations that are under 660 FICO, and you can find populations, they pay their bills, they're very good. But guess what? They have thin credit. A common trap of credit card issuers is to give new credit entrants, people to the population, $500 credit limits. We all know this, right? As soon as you're 30% utilized on your credit card, your score drops like a rock. So they trap them that way, so no one will look at them. And your FICO score is used to give you insurance, to rent an apartment, to buy a car. So credit unions can beat them at this game. So I was CMO at Springleaf One Main. Branch-based lender, 28% lender, average FICO, 600. We did a budget, we had a 3 to 5% loss rate, right? And every credit union in here should not be letting them do loans in your market, because 10% of that rate goes to pay for the branch, just to have a branch. Their cost of funds, they don't have what you have. They don't have a low cost of funds. They have to securitize. They pay 4 to 5% for their money. You pay 1 or less or 2. So you can beat them at their own game if you underwrite differently. FICO isn't the tool to use on these populations, right? And neither is if you pay your cell phone. That I've never seen that actually come in. Everyone likes to talk about that. Right. But you've got the bank transaction data. You have the core. You know, you have their deposits. That's such rich data. So I'll shut up there.
That's really great. And it kind of touches on a conversation we started yesterday, right? About predatory lending and payday lenders and how there's more of them than McDonald's in the United States. And we talked about kicking them out, right? But I hope we don't kick them out until we have an alternative program for them. And until we're willing to reach down in that credit score area, we kind of don't, right? So taking away their only product wouldn't really work for them. You know, yay, we get the predators out, but now they have no place to go. So how do we get there? How do we lend to people responsibly that have these low scores? Is it through education and getting them there? Is it through taking a risk? Like, how do we reach them? I think QCash is great. It's for current members. What about the non-members? How do we get them? We talked about big data. Could we use big data to find out which of our members, and may I say employees, are using payday lending, and then go after them. So let's talk about data. Do you use data to try to find the people in your space that need the help, with their credit scores? Or how do you help them move up the ladder so that your next loan is less expensive for them?
Yeah, I'd like to, I guess, maybe approach it again from a different perspective. Data used correctly and used appropriately, and good data will definitely reveal important information. But data that is, for example, the FICO scores, they use one of the pillars, of course, is the history, right? The payment history. Well, that tends to tie people, chain people to their history, to their difficult moments in their life where they have been unable to get past, to survive. So they've done things that perhaps weren't wise. So the problem with FICO scores in terms of the populations that I'm working with, that I'm thinking about, is that it chains them to their past behaviors. It doesn't consider the fact that they have matured, they have employment, they have education, perhaps they have a lot more grounding in their community, and so they're much more of a community member now. So that is one area where I think that the FICO scores and how we are using credit scoring systems to identify our membership, whether they're good, bad, excellent credit risk. I think we have to be open up to other options. And I know that I'm not too familiar with all of the different FICO. I didn't realize there were so many. I think somebody said there was over 60 or something. And so I'm not terribly familiar with all of them, but it seems to me that they're all private credit scoring systems. So much like the U.S. Post Office, perhaps having a public credit scoring systems would be something that would be worth considering. I'm not sure how that goes over with this crowd, but I'm throwing it out there. Because the communities that are most in need in our county are counting on us to be able to see them where they are. And if we're only seeing our prime borrowers, and we are discounting or disregarding the credit invisible population, we're discounting a large portion of our population. Those communities of color in our community that are credit invisible, we're discounting them. In Ventura County, we are about 45% Latino, 45% white in our county. We have a very small Black and very small Asian. So the work that we do in public health has been focused on that community. But there's all kinds of growing communities, and we need to look at the way we are helping them get credit in order to establish themselves in the community.
What I keep hearing from you is the medical model of treating the whole person. The medical model is about treating the whole person. And what if we followed that model in the financial space, right? And looked at the whole person.
Well, actually, I should say that public health is about prevention. We are not the medical model. Medical model is treating the person after they are already sick. Public health is about
keeping them healthy,
preventing them from getting sick.
Thank you for clarifying that. Gentlemen, would you like to add anything else?
Well, I think, you go back to it. We've all grown up with the 3 C's of credit. What is it? Collateral, capacity, and character. And so we're talking about FICO. And, FICO was invented, by Fair Isaac over in Marin County all those years ago, and now everybody uses it. That's a heavy weighting on the character component. And so then you've got collateral, and a lot of people like collateral because you don't lose as much money on it, supposedly. And capacity is jobs or your ability to pay. So I think that what people have to learn, it's sort of like on the commercial side of the business. If you've ever done commercial lending, you used a RMA as to look at what others were in the various touch points. And so I think you have to do more storybook lending. That's really what it's all about. And you have to sort of lay out you've got all those 700s that you mentioned. Make that an automated kind of decision. Don't spend your time on having an underwriter to underwrite and feel all good about it. You just get it done. And then you pick a spot, hopefully a very low spot, of what you're not going to do. And that gives you more time to work with people that might have the dents and dings that are in there. You're doing more of the storybook lending. My challenge with credit unions, and I know we're talking to a national audience here, is that I think credit unions, you think about CRA, where it come into place back in 77. It's a bad word in our industry. But banks someone had to put a gun to their head to say, go back into those communities to lend. And I always remember Lisa worked at a credit union, San Mateo Credit Union, East Palo Alto, one of the toughest areas around a long time ago. I used to go there and get my hair cut when I had hair, but but nobody wanted to go to East Palo Alto. Right across the freeway, Palo Alto, one of the pristine areas. You couldn't find a bank, you couldn't find a credit union in that marketplace. And I think Barry Gillette put a branch in there. It's old school, but you create a physical presence. And many credit unions, many in this room here, passed on that kind of deal. We've done a couple of mergers here recently, and you hear people, oh, you're being predatory, lending, merging, those kinds of things. It's in a similar kind of environment out in Stockton. Stockton was a town that went bankrupt. Oh my God, why would you want to go to Stockton? That was board members, that was employees. But that's where a lot of the activity is happening, because the folks that live in the Tri-Valley of Pleasant and Livermore and Dublin, they're all running around these $2 million homes in the area. They don't need any money, but people in Stockton, they do. But you still hear, well, why would you go and do that? And that story is the case in a lot of areas. I've grown up in the Bay Area most of my life, so I can't speak for the nation, but places like Richmond are challenging areas. You see things like Oakland, oh God, I might get shot, I don't want to be in that area. But you don't see a lot of financial institutions, banks or credit unions there. And I'm not saying to go out there and build a 5,000 square foot mausoleum in that location, but maybe it's a loan facility so that when people do have questions with all the technology, that you have somewhat of a physical presence. And if you can't build a physical presence, then become engaged in some of the community of activities that are there, so that you can be there and just be a physical presence for such, because there is that distrust, and it's all about presence. Thank you.
I love that term, storybook lending. I'm definitely stealing that one. Scott, would you like to add anything before we open it up?
Yeah, the last thing I'd say is to echo your point. Everybody, I think a lot of the credit unions focus on a one-size-fits-all underwriting for your customer, your member base, and you have one product fits all. Well, guess what? Microloans are great for starting small businesses in communities, right? $100, $500, doing those loans. But I bet you they don't occur to you. You're doing a personal loan for $6,000 or $10,000, or a credit card with a $10,000 limit, a mortgage, a HELOC. You have to look at the population and go, you're serving this population. All right, it's not working down here. What will work there? There people have different needs, have different income. Everyone's not like you. And market research is called looking in the mirror, right? Where you think everyone's like you. So you can't do that, right? Because they're not. They're not all bald white guys like me or like you, right? And that's how we build products for the members and our footprints, right? So not one size fits all.
I thought we were a lot alike right here, right?
Yeah.
Well, you're
We'd love to open it up for questions for our
May I
panelists.
just add one more
Oh,
piece?
sure, of course.
I don't know if Erin Mendez is in the room, but she talked about financial well-being, and that really caught me, because I think the one group that you have to start with is your own employees in the credit unions. We're asking people, I think you mentioned you have some financial wellness experts that are out in the community. But I have to be honest with you, I'm not quite so sure that our employees, we consider ourselves a moderate employer. We're not a Google or a Meta, where these people are having all these different stock options. And some of the employees right in your own room might be having their challenges. And so that is what I would recommend, that you take stock of some of the folks that are there. As a CEO, and I came up on the lending side. I'm not that's where I came through, looking at our employee credits and doing that storybook lending, bending just a little bit where it makes sense on those 3 C's might not be a bad idea. That's the last comment. Thank you.
Thank you so much. We're going to open it up now. Does have any questions?
I would love Frank to just repeat a stat
Sure.
he just said to me.
There's, you can see it, CU Today, if you want to search it. We reported it. PSCU research shows 60% of credit union employees consider themselves financially stressed.
Right, they're no different basically than the general public, and that's hard to hear, isn't it? Because we're also expecting them to talk to our members. So starting at home starts like a good place to start, yeah. So opening it up, certainly when you ever heard that thing, if you're the smartest person in the room, find a different room, right? I don't have that problem. The brain trust in this room is so strong, not only on this panel, but all the panels. I just, thanks again for all of that. And if you'd like to ask any questions of this panel, now would be the time. Or add anything to the topic.
We don't use FICO to make a decision. I do like to think that we do some storybook lending, but I think one of the things that we are a little concerned about is if we want to use different rules for different people, we have to worry about fair lending. And so I think that kind of holds us back a little bit, at least on the pricing side. So we'll make the loan to you, but we use Vantage, not FICO, but we do price it based on the score. So just a little bit concerned about what do you guys think about getting into trouble with fair lending if you're using other things to make decisions for people?
From y'all first.
I think you're spot on. I think FICO is the constant on the pricing on the loan. So I think you stay there. I think it's not a bad idea that once that loan is made, and I am certainly not saying that we are doing this, why not go back and look at that individual 12 to 18 months down the road and try to provide some additional favorable pricing, if you would. But I think you can continue to use FICO as your pricing tool. I think our panel is more about, looking at different ways of how to grant credit.
Turn that around because I've actually done pricing at Chase, Barclays, a lot of banks. I look at the loss rate. You got a risk tier, A through H, 1 through 10, 1 through 20. It has a loss rate that your models have calculated, and you price according to that, the risk and the volatility and the return you need. So I would step away for fair lending. You're trying to assess the risk of different populations and separate the goods from the bads. So if you use different data, as long as there's not implicit bias in the data, right? Obviously, we have implicit bias and explicit bias. So if we're using traditional credit bureau data to underwrite a segment of population, think of in credit cards, we would do thick file and thin file models. And there's FICO scores for that. If you got a thin file population, you would have a different risk model for them. There's no fair lending issue with that because you can't rely on the fact that they don't have 10 years of credit history. What if it's a new immigrant? It's a H-1B visa who could be making $150,000 as a coder, right? And you're going to say, I'm not going to give that person credit? That makes no sense. So I think it's the data you use, and I do pricing based on risk tier. Just go to like Lending Club when you used to be able to buy the loans. A through H. A's were like less than 1% loss rate, and they're priced a certain way. So that takes it away, and that also takes the power away from FICO. I think FICO is a little bit like diamonds. So,
Anything to add, Selva?
Yeah, I'd like to say that you mentioned data. If you use biased data as your gauge, then you're going to perpetuate bias. So what I would suggest a combination. Obviously, I don't know all of the legalities, so I'm not even going to attempt to do that. I'm just going to have you look at your communities where in Ventura County, for example, we have small businesses who have been there for ages, for years. They are the hub of their community. Communities relied on them during the pandemic to help them overcome, food insecurity, to overcome issues of credit. And so looking at your community businesses and how good they have maintained over the years. So using not just FICO, but using other and data, of course, data that's key. But I like your idea of checking in with them and seeing where they are in their repayment, in their improved credit, just in terms of other additional credit. Those are some of the things that come to mind. I don't pretend to address all of the issues that you face as an institution, but from the community perspective, there are people out there who have a long history of paying back or paying their rent, paying their bills, paying their credit, and nobody wants to take a what do you call it, a chance on them because they don't have it on the books anywhere. So knowing your community and having that person within your institution, those individuals within your institution, and that could be your employees who know their community because they live in your community, is having them weigh in on your policies, your strategies, your what you do to gain your customers and gain their trust, because that, I think, is key. And I think people have mentioned it before on this panel, the importance and value that trust brings to the table.
Thank you so much. And we are at time, unfortunately, because we could go on and on about credit. But thank you, Harold and Scott and Sofa. Thank you all for your time.